been an eventful start to 2015 for global financial markets, with a number of surprising announcements by central banks driving returns in global markets. The European Central Bank embarked on a large quantitative easing program. Political risk re-emerged in Greece. The US Federal Reserve, the Fed, inched closer to its first rate hike, and concerns were raised over the slowdown in China. Australia also joined in with 2 rate cuts by the Reserve Bank of Australia to a new record low of 2%, while central banks in Canada, China, Indonesia, Korea, Thailand and India all cut interest rates as well. The global economy grew, led by the US, China and other emerging economies, while there were tentative signs of an improvement in economic growth in Europe. The International Monetary Fund expects growth of 3.5% this year, up from 3.4% in 2014. Growth of 3.8% is expected in 2016. Volatility was a highlight for financial markets and the global economy. Share markets around the world have mostly recorded gains the year to date, led by Europe and driven by stimulus measures from Europe, Japan and China. These gains have occurred despite extended negotiations in Greece over its current bailout agreement and whether it would meet its financial and reform commitments and stay in the euro area. This issue is likely to remain on the agenda for the remainder of 2015 as negotiations continue and ultimately decide the reform and commitment they are willing to provide to keep the euro. While it's a small economy, with 80% of its debt held by the public sector, it's still creating waves in financial markets. Elsewhere in Europe, there have been tentative signs the economy is slowly improving, helped by a weaker euro and aggressive stimulus by the European Central Bank. In the US, economic growth disappointed in the first quarter of 2015, with the cold winter, a stronger US dollar, a port strike in California, and the lower oil price all leading to the weak result. There are signs that growth has begun to rebound in the second quarter, with the labour market continuing to improve. In 2015 to date, over 1 million jobs have been added to the US economy. The unemployment rate is now 5.5% and should fall further by the end of this year. The gains in the labour market have prompted the US Federal Reserve to suggest they will raise interest rates off zero later this year. This will be the first rate hike since 2006. The timing and magnitude of future interest rate rises remain open to debate. The biggest impediment to lifting rates is inflation, or more importantly, the lack of it. Given the fall in the oil price, inflation is low in the US, currently flat for the 12 months to May 2015, compared to the Fed's target of 2%. At this stage, the low inflation rate and subdued wages growth has delayed rate hikes, but it's likely that the time is getting closer, given the economic recovery, for interest rates to move higher later this year. In China, economic growth has slowed to 7% for the year to March 2015, as designed by policymakers. However, indicators are the economy has continued to slow, most likely faster than desired, and as a result, commodity price weakened and the government has implemented stimulus measures, mostly through lower interest rates to help support growth. Closer to home, the Australian economy is growing below its normal trend rate of 3%. The latest reading showed economic growth of 2.3% for the 12 months to March 2015. Most of this growth was driven by rising export volumes, with domestic demand weak and low income growth due to the fall in the terms of trade driven by commodity prices. Mining capital expenditure has peaked and is now falling, detracting from growth. However, at the same time, the cash rate was lowered to a record low 2% to help the Australian economy transition from mining to non-mining sources of growth. The lower Australian dollar is helping, but at the same time the iron ore price fell, which is also impacting government revenue and the income earned for Australia. The good news is the labour market in Australia is holding up, despite sub-trend economic growth. The unemployment rate was 6%, in May 2015, with over 100,000 jobs added to the economy this year. Jobs have been added to predominantly services industries like healthcare and education. The remainder of 2015 is set to deliver more surprises. In particular, the world awaits the first interest rate hike in the US since 2006, which could deliver with it considerable volatility for global markets. This rate hike would be the result of substantial improvement in the US economy and the labour market since the depths of the 2009 recession. Currently, September this year is the most likely start date for higher interest rates. What is more uncertain is the pace and extent of any rate rises off zero and how global markets will react to this. Volatility in share markets and bond markets are expected. Further stimulus is expected out of Europe as the European Central Bank continues its aggressive quantitative easing program by purchasing government bonds and trying to lift inflation expectations and promote economic growth. Japan and China could also be expected to boost stimulus efforts to power economic growth, given low inflation pressures. We remain fairly optimistic on China. The government continues to try to rebalance the economy away from property and investment towards services. Its expected economic growth will slow to below 7% this year, and further stimulus measures should help to stabilise growth. Importantly, lower economic growth rates in China should be sufficient to maintain employment growth due to the ageing population. The Australian share market has been volatile, like other global markets. Investors remain focused on a search for returns, given low cash rates and low bond rates, even despite some upward pressure in rates in recent months. The Australian economy is expected to grow at a bit below trend in the remainder of 2015, as it continues its slow transition from mining to non-mining sources of growth. Lower iron ore prices are likely to hurt and directly impact the federal budget and income growth in the economy. The Australian dollar should continue to fall and help the economy to rebalance, particularly as the first rate hike in the US inches closer. The Reserve Bank will be watching developments closely, especially inflation and unemployment rate, as well as confidence levels. Both the Australian dollar and the unemployment rate will be crucial to the next move by the RBA, and the possibility remains for further reductions in the cash rate. 2015 is shaping up to be a pivotal year for the Australian economy as we define our next phase of prosperity. Importantly, the global economy is set to grow faster this year than last year at around 3.5%. Cash rates are low globally, and central banks are providing considerable help to keep healing the global economy and support markets.